For many Australians in 2026, the dream of homeownership feels locked out behind a wall of rising prices and strict lending criteria. Because the barriers are so high, prospective buyers often treat saving a deposit as the absolute conclusion of their struggle. They assume that once they have the cash for a down payment, the financial risks are behind them. In reality, signing a contract without high-level financial literacy is like walking into a complex machine designed to extract wealth. Small, technical oversights during the purchase phase create a chain reaction of compounding losses. To see how these costs accumulate, we are tracking a typical purchase through a digital ledger to calculate the exact price of 10 common mistakes. The damage from these errors is often invisible on settlement day. Instead, it acts as a silent drain on your net worth, siphoning away capital that should have funded your future. The process begins with the loan application. A frequent mistake is assuming your bank's mortgage rate moves in lockstep with the official RBA cash rate. This lack of clarity leads to the first two errors: accepting an unoptimized retail loan directly from a bank branch and failing to utilize a broker to access government guarantee schemes that can waive lenders' mortgage insurance. On a $600,000 mortgage, a rate just 0.5% higher than a broker's option adds $190 to your monthly bill. Over 30 years, that single oversight generates over $68,000 in additional interest. We add that $68,000 to the ledger as a long-term financing penalty. Your upfront financial strategy determines the baseline profitability of the home. A bad structure ensures the bank earns more from the asset than you do. Once you start attending auctions, market pressure can quickly override logic, leading to aggressive bidding on properties that don't fit your long-term goals. This creates errors 3 and 4, ignoring sister suburbs with better value and buying a subpar house in a premium area. While you pay a premium to enter the neighborhood, these properties often underperform in capital growth compared to a high-quality home in a rising suburb. Errors 5 and 6 occur when buyers submit offers without finance and building clauses. This leaves you legally committed to the purchase, even if your bank's valuation comes back low or the property has major defects. A 1% difference in annual capital growth on an $800,000 property results in a $75,000 equity gap over a decade. When combined with the legal risk of a forfeited deposit, the ledger surges again. Emotional urgency often masks these structural financial risks until it is too late to withdraw from the contract. As you approach the final days before taking possession, the pressure to finalize the deal reaches its peak. Errors 7 and 8 involve skipping independent building and pest inspections to save roughly $500 in upfront costs. Without a professional report, you can easily inherit a home with hidden structural failure or active pest infestations. Once the title transfers, these repairs become an immediate cash liability that your mortgage won't cover. Finally, errors 9 and 10 involve miscalculating stamp duty and settlement fees, leaving you without the cash reserves needed for emergency repairs or mandatory adjustment. By combining the $68,000 in extra interest, $75,000 in lost equity, and an estimated $60,000 for structural remediation and mismanaged fees, the ledger hits a total loss of over $200,000. Avoiding minor, inexpensive due diligence steps creates the largest unfinanceable cash shocks of the entire transaction. A $200,000 loss represents a specific, crushing reality for a first-time buyer. This figure is equivalent to a decade of extra labor or a significantly delayed retirement. It can leave a homeowner in negative equity, unable to sell or refine their position when interest rates shift. To succeed, you must view a home as a leveraged financial instrument. It is a business acquisition that requires objective analysis rather than emotional attachment. By utilizing expert brokers to navigate these systemic traps, you can bypass the common errors that strip wealth from the average buyer. Success isn't defined by the day you move in, but by how well you protect the generational wealth that property is capable of producing.